How did Dodd-Frank change financial derivatives regulation? Have you ever wondered how the rules governing financial derivatives changed after the financial crisis? The Dodd-Frank Wall Street Reform and Consumer Protection Act brought significant changes to this area. This legislation was introduced in response to the financial crisis from 2007 to 2009, where unregulated derivatives markets played a big role in the chaos. Before Dodd-Frank, many financial derivatives, especially over-the-counter derivatives, operated with little oversight. The act aimed to increase transparency and reduce risks in these markets. One of the key changes was the requirement for standardized derivatives to be cleared through central clearinghouses. These clearinghouses act as middlemen between buyers and sellers, which helps lower the risk of one party failing to meet their obligations. Another major shift was the move of many derivatives trades from private agreements to regulated exchanges or swap execution facilities. This change made pricing and trading information accessible to the public. With this transparency, market participants can make better informed decisions, leading to fairer pricing. Dodd-Frank also imposed new registration, capital, and margin requirements on swap dealers and major swap participants. Swap dealers are firms that frequently engage in derivatives trading, while major swap participants are large entities with significant exposure to derivatives. These requirements ensure that these firms have enough financial resources to cover potential losses, which helps protect the overall financial system. The Act introduced strict business conduct standards and extensive record-keeping and reporting obligations. Swap dealers and major participants must provide detailed information about their derivatives activities to regulators. This transparency allows for closer supervision and helps identify and address risks early on. Additionally, Dodd-Frank prohibited federal assistance, like bailouts, for certain financial institutions involved in derivatives trading. This measure aimed to prevent moral hazard, where firms might take excessive risks, expecting government help if things go wrong. Historically, Dodd-Frank's reforms built on existing regulations, particularly those for futures markets, extending similar principles to the previously less regulated swaps markets. The Act aimed to balance the need for active derivatives markets, which are essential for managing risk, with the need to prevent these markets from worsening financial crises. In practice, these reforms have changed how financial institutions, corporations, and other market players manage risk through derivatives. By increasing transparency and enforcing stricter controls, Dodd-Frank has contributed to a safer financial environment. However, discussions about the costs and effectiveness of these regulations continue. Overall, Dodd-Frank transformed financial derivatives regulation by introducing central clearing, enhancing transparency through regulated trading platforms, imposing capital and margin requirements, enforcing registration and reporting obligations, and restricting federal support to risky institutions. These changes aim to address vulnerabilities exposed during the financial crisis and promote a more resilient financial system.